Welcome to The Explainer. We've got a lot to cover today. June 23rd was just an absolutely massive day in fintech. While the basketball internet was totally glued to the NBA draft last night, waiting to see where top prospects like AJ Dubonsa would land, the financial world decided to drop a starting lineup of its very own. We literally saw some major industry-shaking moves hit the wire all at the exact same time.
The industry newsletter Fintech Stacks summed up the vibe perfectly. 3 product launches, 1 rebrand, and 0 chill. Okay, let's just dive right into this because the sheer pace and, frankly, the high stakes of today's news really tells a fascinating story about exactly where our money is heading.
So here's our starting lineup for today's explainer. First up, LendingClub graduates to Happen Bank. Second, SoFi simplifies AI trading strategies. And third, Wealthfront banks on rich parents. These 3 stories perfectly illustrate our central theme today. Fintech is officially growing up.
All right, kicking things off with LendingClub graduating to Happen Bank, a 12-year identity shift.
We are officially witnessing the end of their NYSE era and the dawn of the Nasdaq era. And listen to exactly how CEO Scott Sanborn describes what they're becoming. He calls it a diversified, digital-first bank. Now, this is absolutely crucial to understand. This isn't just some cosmetic name change or a fresh coat of paint on an old app. No, it's a fundamental shift in their entire business model. By moving over to the Nasdaq, they're actively planting their flag with a tech-forward investor base rather than the old guard crowd at the New York Stock Exchange.
Let's take a quick look at how they actually got here. They launched way back in 2006 as one of the original peer-to-peer lending disruptors. But this graduation to Happen Bank, that took years of quiet execution. Back in 2021, they acquired Radius Bank to secure a national charter. Fast forward to Q1 of 2026, and they had strong originations and had launched products like Debt IQ. That really signaled their intent to own the full financial life cycle of their customers, not just that single moment a loan is originated. They didn't just wake up and pivot yesterday, They really earned this Nasdaq debut.
To put it in pop culture terms, this evolution is a lot like when Jay-Z stopped going by Jigga and became a businessman. The flashy new Happen Bank logo isn't really the story here. The real narrative is that underlying 12-year arc of quiet rebuilding into a full-service, profitable digital bank. Honestly, it's something their original Series A investors probably never even modeled out. They really just graduated.
So the underlying banking institutions are clearly evolving, right? But that raises a pretty obvious question. What about the retail traders? How exactly are the tools for the everyday investor maturing alongside these banks?
That brings us to our second point. SoFi simplifies AI trading strategies, the technology shift.
SoFi basically just handed retail investors the equivalent of a Wall Street trading desk with their new product, Composer. Let's demystify what this tech actually is. Yes, Composer is an AI-powered investing platform, but we need to be crystal clear about what it is not. CEO Anthony Noto was super explicit here. This is not some autonomous AI agent making wild independent bets with your hard-earned cash. The AI simply executes the rules you defined. Think less the robot is completely taking over the world, and more the robot does exactly what I tell it to do consistently without me having to babysit it all day long.
And the process is incredibly user-friendly. It requires absolutely 0 code. First off, you define your thesis in plain English. Like, you might literally type tech in bull markets, ETFs when volatility spikes. Next, Composer's AI builds that exact strategy out for you. Then, you review its historical performance to see how it would have held up in the past. And finally, you set it to auto-execute, which it can do on a daily basis. It's so controlled and puts the steering wheel entirely in the user's hands.
Now, why is SoFi doing this right now? $15 million. That was SoFi's brokerage fee revenue in Q1 of 2026, which is more than double what it was. That kind of surging revenue is exactly why they are so highly motivated to launch a premium investing product at this specific moment.
Here are the core specs for the launch. Composer goes live with over 2,000 community-built strategies ready to browse right out of the gate. It requires just a $50 minimum balance, but here's the catch. It costs $40 a month or $384 a year. SoFi is actively targeting the maturing retail investor here. They want the wallet share of the crowd that maybe started out on Robinhood, but has kind of grown up. The folks who've outgrown the celebratory confetti animations and are now totally willing to pay for serious, set-it-and-forget-it market tools.
All right, so if the tools and the banks are maturing for the adults in the room, what on earth are these companies building for the next generation? How does this maturing landscape actually address the kids?
Which leads us right into our third segment, Wealthfront banks on rich parents.
the demographic shift.
So, Wealthfront just launched a brand new custodial account for minors. And the real key here is the specific financial architecture they've built. This is a taxable, automated investing account that features tax gain harvesting. It systematically targets up to $1,350 a year in tax-free realized gains per child. It does this by selling appreciated assets while the kid is still in a low or zero federal tax bracket. Pretty smart, right? It has a $500 minimum, a standard 0.25% advisory fee, and they're even running a promo for $100 in seed funding if you open it up by July 23rd. It's basically custom built for that extremely relatable panic when a kid arrives and you suddenly find yourself frantically Googling 529 plans at midnight.
And honestly, their internal data brilliantly illustrates exactly why Wealthfront built this. Look at their assets under management, or AUM. Clients who aren't parents hold an average of $27,000, but clients identified as parents, they hold an average of $91,000. That is a staggering 3.4x wealth gap. Wealthfront didn't just build this out of pure altruism. They realized their highest AUM segment was aging into a completely new life stage. They were going from a cash account in their late 20s to retirement planning in their early 30s to suddenly having kids. The platform desperately needed a product to serve them and to catch that next generation of wealth.
The timing of this is also highly strategic. On July 4th, we'll see the launch of Trump accounts, which are these new, government-restricted, tax-advantaged accounts for minors. By launching their custodial account right now, Wealthfront is directly positioning itself in the market as the automated, highly flexible alternative. It's for parents who want a tax-smart vehicle, but maybe desire a bit more flexibility than a government-restricted account might offer. It is just a fascinating look at competitive market timing.
All right, let's wrap this up with our final section. The theme, compound interest.
The underlying theme of this entire fintech renaissance really boils down to compound interest. But, it's not just the traditional compound interest we're so used to talking about. Think about it. LendingClub proved the power of compounding equity in your brand and business model over a 12-year arc. SoFi is literally selling the ability to compound your trading strategies through algorithmic consistency, and Wealthfront is building the actual tools to compound generational wealth for your kids' future. Fintech has, well and truly, matured.
Which leaves us with one final, incredibly important question to reflect on today. If fintech is officially growing up, is your personal financial strategy maturing right along with it? Just as a quick reminder, everything we discussed in this explainer is for information and entertainment purposes only and is absolutely not investment advice. Thank you so much for hanging out with me as we broke down these sources today. Keep learning, keep growing, and I will see you in the next explainer.